Today we're reviewing property, plant, and equipment, depreciation methods, partial year depreciation traps, disposals, and depletion. These are heavily tested topics because the exam loves to combine asset acquisition, depreciation calculations, disposals, and depletion into one simulation. Part 1. Property, plant, and equipment. Property, plant, and equipment, often called PP&E, represents tangible assets used in operations that provide benefits for more than 1 year. Examples include land, buildings, machinery, equipment, furniture, fixtures, and vehicles. The first thing to remember is that when acquiring a fixed asset, you capitalize all costs necessary to acquire the asset and place it into service. Think of the phrase, ready for use. If the cost is necessary to get the asset ready for use, capitalize it. For equipment, this includes the purchase price, freight, shipping, installation, testing, and sales taxes. For self-constructed assets, capitalize direct materials, direct labor, and construction period interest. Remember, self-constructed asset equals capitalized direct materials, direct labor, and construction interest. The exam frequently tests construction period interest. Interest incurred while constructing a building is capitalized. Once the asset is ready for use, interest is expensed. Part 2. Land and land improvements. Land includes all costs necessary to prepare the land for its intended use. Examples include the purchase price, title fees, legal fees, recording fees, survey costs, assumed obligations of the seller such as liens or delinquent property taxes, grading, clearing, and site preparation. One major CPA trap involves demolition. If an old building is demolished to prepare land for a new building, the demolition cost is added to land. Any scrap proceeds reduce the land cost. Remember, demolition cost minus scrap proceeds equals land. Another common trap is land improvements. Land itself is not depreciated because it has an indefinite life. However, land improvements are depreciated. Examples include parking lots, fences, sidewalks, outdoor lighting, and irrigation systems. Think, land equals no depreciation. Land improvements equal depreciation. Part 3. Basket purchases. The exam also likes basket purchases. Sometimes land and a building are purchased together for one price. When that happens, allocate the purchase price based on relative fair values. The formula is asset fair value divided by total fair value multiplied by total purchase price. Remember, allocate based on fair values, not book values. Part 4. Repairs versus improvements. This is another favorite CPA exam topic. Ordinary repairs are expensed because they simply maintain the asset. Examples include routine maintenance, painting, cleaning, and minor repairs. Improvements, additions, and extraordinary repairs are capitalized because they increase capacity, improve efficiency, or extend useful life. Think, maintain equals expense, improve equals capitalize. Part 5. What is depreciation? Depreciation is the systematic allocation of cost over an asset's useful life. Depreciation does not measure market value. It simply allocates cost. The basic depreciation formula is cost minus salvage value divided by useful life. Keep that formula in mind because every depreciation method starts with the same concept, allocating cost over time. Part 6. Straight line depreciation. Straight line depreciation is the simplest method and produces the same depreciation expense every year. Suppose equipment costs $50,000, has a salvage value of $5,000, and a useful life of 5 years. Depreciation would be $50,000 minus $5,000 divided by 5 years. That equals $9,000 per year. Remember, straight line equals the same expense every year. Part 7. Sum of the year's digits. Sum of the year's digits is an accelerated depreciation method. This means more depreciation is recognized in the early years and less depreciation is recognized in later years. Step 1 is to find the depreciable base, which equals cost minus salvage value. Step 2 is to calculate the denominator. If useful life is 5 years, The denominator equals 5 plus 4 plus 3 plus 2 plus 1. That equals 15. The first year fraction is 5/15. The second year fraction is 4/15. Then 3/15, 2/15, and finally 1/15. Remember, always use the largest fraction first. Part 8. Double declining balance. Double declining balance is one of the most tested depreciation methods on the CPA exam. Start by finding the straight line rate. If useful life is 5 years, the straight line rate is 20%. Double it. 20% becomes 40%. Apply the 40% rate to beginning book value each year. Notice an important rule. Double declining balance ignores salvage value during annual calculations. However, book value can never be depreciated below salvage value. Think. Ignore salvage during calculations. Respect salvage at the end. Part 9. Units of production. Units of production is a usage-based depreciation method rather than a time-based method. The formula is cost minus salvage value divided by total estimated units. That gives you a depreciation rate per unit. Then multiply by actual units produced during the year. If production doubles, depreciation doubles. If production falls, depreciation falls. Remember, more usage equals more depreciation. Part 10. Partial year depreciation. One of the biggest CPA traps is partial year depreciation. The exam loves purchasing assets in the middle of the year. Whenever an asset is purchased during the year, do not take a full year of depreciation. Take only the portion of the year the asset was actually in service. The formula is annual depreciation multiplied by months used divided by 12. Remember, only depreciate for the months the asset is in service. Part 11. Half-year convention, and their major CPA trap is the half-year convention. Under the half-year convention, assume assets are placed in service at the midpoint of the year. The first year receives 1/2 year of depreciation. The final year receives 1/2 year of depreciation. The years in between receive full depreciation. Remember, half year in the first year, half year in the final year, full years in between. Part 12. Disposal of assets. The CPA exam frequently tests gains and losses on disposal. The first step is always to update depreciation through the date of sale. Remember, record depreciation through the date of sale before calculating gain or loss. After updating depreciation, calculate book value. Book value equals cost minus accumulated depreciation. Then compare the sales proceeds to book value. If proceeds exceed book value, recognize a gain. If proceeds are less than book value, recognize a loss. The process is update depreciation, calculate book value, compare proceeds to book value, record gain or loss. Part 13. Depletion. Depletion is depreciation for natural resources such as oil, gas, timber, coal, and minerals. The depletion base includes acquisition costs, development costs, and restoration costs, less residual value. The formula is acquisition cost plus development costs plus restoration costs minus residual value. This equals the depletion base. Next, calculate the depletion rate. Depletion base divided by total estimated units. Finally, multiply units extracted by the depletion rate. Remember, extracted affects inventory. Sold affects cost of goods sold. Part 14. Final exam day review. Capitalize costs necessary to acquire and prepare an asset for use. Land is not depreciated. Land improvements are depreciated. Construction period interest is capitalized. Self-constructed assets capitalize direct materials, direct labor, and construction interest. Basket purchases use relative fair values. Maintain equals expense. Improve equals capitalize. Straight line produces equal depreciation each year. Sum of the year's digits and double declining balance are accelerated methods. Double declining balance ignores salvage during calculations, but never depreciates below salvage value. Units of production is based on usage, not time. Always watch for partial year depreciation and half-year convention questions. When disposing of an asset, update depreciation first. Depletion applies to natural resources. Extracted creates inventory. Sold creates cost of goods sold. If you can remember those concepts and formulas, you'll be in excellent shape for the property, plant, and equipment questions commonly tested on the CPA exam.